Think landlords got it easy? Think again. Over $1.5 trillion in commercial real estate is due by the end of next year, and a quarter of it is almost impossible to refinance. Why? Because higher interest rates have tanked building values, making it tough for landlords to borrow enough money. Let's not forget that Wall Street has a headache as well, because a lot of their risky loans are bundled into bonds sold to investors. So is this the calm before the storm, or just a temporary reprieve? Let's talk about this. Hey there, hope all is well. Just wanted to check in for a quick minute to share with you some interesting developments into this whole commercial real estate unraveling, which I believe will be a key contributor to the overall devastation of our global economy, just because there's no end in sight and we haven't even seen the worst of what is yet to come due to the current environment we're in with the high interest rates and the insolvency, for the most part, of a lot of these smaller regional banks that are taking on losses that we could never imagine. But then again, it's real. And so I came across an interesting article here that I want to share my 2 cents on, as well as just, get your thoughts on it as well. So feel free to add to this in the comment section. And I definitely would love to find out more of what you think and more of your analysis as well. But simply put here, this article I want to bring to your attention here, 1.5 trillion of commercial real estate debt is due next year, and refinancing won't be easy. So right now, everybody's keeping an eye on the Fed, anticipate some type of rate cut, assuming that's going to help. But because the debt is so large and it's so, I guess, it's just massive in and of itself, there's no way of actually being able to maintain the current trajectory of debt, nevertheless make payments on the debt at this current moment, given the fact that there is no real genuine growth in the economy. So things are definitely going to pick up speed as far as unraveling, and it's going to definitely prick more pins in this all asset class bubbles that will eventually come down to Main Street, and it'll be obvious at that point where the economy is at. And so there'll be no vagueness in reference to whether or not people say we're in a recession or not, because, as I've always stated before, based upon all the key metrics that once were solid, all point to the fact that we are beyond the point of a recession. And it's just a matter of that, I guess, final nail in the coffin to really bring it home. But real quick here, I wanted to share some thoughts and thumb through this real briefly here, and just basically just let you know what's really going on outside of what you guys already know. But what really stood out to me when it talks about landlords and just the complete destruction of their investment model. And so here it says, landlords for offices, apartment complexes, and commercial real estate have 1.5 trillion of debt due by the end of next year. About a quarter of that borrowing could be hard to refinance. It says here, apartment buildings, which make up about 40% of looming maturities, are at the center of the refinancing wave, the broker said. So imagine we lived in an environment where borrowing was cheap for well over a decade. And now that those costs now are coming due, they're hurting the borrowers themselves, just because a lot of these buildings are vacant and they're not receiving any income on these properties. So literally, I'm watching daily as properties are written off and sold, and for just pennies on a dollar, 9-figure complexes sold for literally 7 to 8 figures, which is definitely more than a 30 to 40% haircut. In some places, even more than 50% of a haircut. And then once again, all that debt is somebody else's asset that was lent out in the form of a loan through this banking process. And so the bank's day of reckoning is definitely coming. So basically, at the end of the day, the commercial real estate market is teetering on the edge of a major crisis that a lot of people aren't paying attention to. Developers fueled by cheap pandemic-era currency built countless apartment complexes, assuming that good times would never end. But unfortunately, that 1.5 trillion in commercial real estate loans is set to mature, and therefore landlords are in trouble. Between falling property values and rising interest rates, they've put these landlords and developers in a very tight corner. And worse still, with fewer tenants to fill these new buildings, cash flows are drying up, making it nearly impossible for property owners to cover their debts. So what happens if you can't cover your debt? Sooner or later, you default or you file for bankruptcy. And that's exactly what they're doing. But there's still some holding on to the fact that hopefully they might lower interest rates low enough to save the day. But history tells a different story. Even when the Federal Reserve cuts rates, banks tend to tighten lending standards, making it harder to get loans. So this cycle is about to hit a critical point, especially with the return of student loan payments at the end of September. With the resumption of the federal student loan payments set to expire at the end of this month, a lot of people are going to make some tough decisions. Right here it says the U.S. Department of Education is now providing a 12-month on-ramp to repayment starting October 1st of 2023 and ending September 30th, 2024. So that's literally at the end of this month. That's when things will come to a head, because renters will have to prioritize their loan payments, and landlords will face even greater challenges in maintaining cash flow, pushing them closer to default. So when you zoom out and you really look at what's going on here, we're looking at a ticking time bomb that could tip the U.S. into a broader financial crisis, because the commercial real estate sector, which was once seen as resilient, is now at the mercy of a tightening credit environment, and a consumer base is stretched very, very thin. So it's a perfect storm, and the fallout will be severe. So just wanted to take a minute, share with you what's happening and what's developing right now as more of these numbers come out, which are completely unpayable. And you better believe the Federal Reserve and Treasury is paying close attention to this, because they are the ones that will have to step in and prop things up or let it fail. And if it fails, there goes the banks and all those daisy chain of events that we talk about all the time on the show. So once again, just sharing with you what's important. Hopefully you recognize the severity of what's going on here. Think outside the box, make preparation for some type of banking event in the future. And once again, whatever you have in the bank, you are a creditor of the bank. So therefore, you're going to be second, third, or fourth creditor to be made whole if you are made whole. So if you're warned, you know better. Hopefully you do better. Only keep in the banks what you know you will be willing to not have access to right away, or perhaps not even get at all. That's just my 2 cents and my opinion. But then again, curious to hear what you say. And as always, you know my mantra, get your weight up as a backup plan to a failing monetary system and protection against a debased currency. But other than that, curious to hear what you think. Drop a comment. If you enjoyed this, hit that thumbs up. Make sure you follow, subscribe for more of these little updates, and I'll catch you later.